When a stock declines from $360 to $60, it is always interesting. Estee Lauder, company is selling skincare, fragrances, makeup, hair care. Now, while some companies have the issue that the stock is crashing because of some narratives, this is because of the fundamentals. Revenue has declined massively, and also one issue Estee Lauder is, they have very high fixed costs. Because while their gross margin is 73% even after the decline, their operating margin declined to 8%. All their stores, the facilities, those cost money. And they did manage to control that part. They now have 900 million in free cash flow. Meanwhile, stock-based comp is sitting at 300 million. So in reality, 600 million in free cash flow. That is a 35 multiple on the market cap. Now, could the free cash flow recover? Let's look more into that. It's not like Estee Lauder has one division which is causing issues. Every single product category is in decline. Skincare 12%, makeup 9%, fragrance 3%, haircare 12%. And it's also across geography. Europe, Middle East, Africa 18%, America 6%. Asia, 3%. Now, like I said before, their problem is the very high costs. They want to change that. However, they expect to occur charges between 1.2 billion and 1.6 billion. They expect that to deliver savings of around 0.9 billion per year. Now, that sounds nice, but even then, they would only have around an 18 multiple afterwards if you count that 101 on the free cash flow. And they still expect the full year 2025 to be worse. Double-digit net sales decline. And when currently only one of your segments even makes money really, skincare, then you really gotta worry. Now, that is the question. Estee Lauder is operating all over the world, and they're roughly split around every continent. They're gonna do their cost restructuring, aka fire a lot of people, abandon locations that are not as profitable. Afterwards, they will have higher profits. And if then the market recovers in the beauty segment, then Estee Lauder will have higher profits than before and be stronger. However, is this the entire beauty segment, or is this just Estee Lauder's issues? Because if I recover costs, but the revenue doesn't go up here and continues to decline, that doesn't matter. Then it's dead money. So let's look at some of the biggest competitors. Why Ulta Beauty is only active in America, we can see them as a competitor in this space. And why Ulta has also had a bit of a harder time, they have not collapsed. Their profitability is still there, it's just not growing anymore. L'Oreal, which also operates very, very globally. Now it has more products, so it's not going to be as affected, but it is also growing. It's also not the luxury market. LVMH is also still growing. So overall, this is just an Estee Lauder problem. Estee Lauder in America has already been in decline for a very, very long time. They had very strong competition. Now they were able to compensate that by the increase in sales in Asia. However, Asian manufacturers have really ramped up. Over the last few years, Asian skincare brands, makeup, etc. has become very popular. These brands have been made more accessible and have been more international. Korean beauty products are expected to grow by 9.2%, reaching $18 billion. Estee Lauder came and filled a gap, but now they're being squeezed out by local manufacturers. And I don't know if Estee Lauder has the scale to go against these changes. They need to innovate more, bring out more products because they're losing market share. If we take CapEx alone, it has collapsed to 600 million. Now, of course, they need to do that. They need to fix their costs, but overall, that is the issue. Estee Lauder is currently spending 600 million in capital expenditures, and that is across the entire world. Meanwhile, Ulta in America alone spends around 400 million. Estee Lauder has done many billion-dollar acquisitions, so not all of its revenue growth was even organic. I don't really see this reversing that easily. And then I think, okay, I have a company in decline, not a big outlook so far to a recovery. So what am I willing to pay for that? Currently, 600 million free cash flow. 35 multiple. Once again, coming to Ulta Beauty, pay a way smaller PE ratio. I get a functioning company with solid profits, doing share buybacks, and all of that fairly organically. I'm not saying it's a buy, but objectively, this is not a great risk-reward ratio. And when your cash flow is 600 million at the time, that is fairly risky. So there's also not a lot of room for investment. Why are you paying out all the money you have right now if you really need it to turn the company around? That is what I don't get. And even if you pay everything out, it's a 2.3% dividend. Now, while this probably shows that the stock is not a buy, let's go into our assumptions anyway to see what we would be willing to pay. First of all, currently we make $2 in free cash flow per share. Now, while they are probably gonna decline for the next few years, let's be optimistic and overall say over the next 5 years they're gonna grow 2% on average per year. Probably not gonna happen, maybe with some of the cost cutting. Afterwards, they innovated a bit. They're not declining anymore, go back to 10% growth, including with buybacks. I think this is very optimistic. 75% payout ratio with a reduction due to taxes, plus a 20 multiple. Even then, we would be at half the current value. Now, what would be something that would need to be reached for the current stock price to be a buy? Immediately, cost cutting increases earnings to 230. 5% growth over the next 5 years. So the company stops declining. All of a sudden, the cost cutting goes into effect. And then afterwards, they grow by 15% per year. There will be huge amount of share buybacks, huge amount of growth. Something they cannot. And then a 25 multiple. Then we would get to $60 a share. However, what do I think is way more likely? They're going to continue declining for the next 5 years by 4% on average per year, which is slower what they are right now. Afterwards, they're going to grow by 4%. They would have kind of turned the ship around, be able to do some share buybacks, and get a 40 multiple, because it is still a troubled company. And then, $17 a share. This stock is just not a buy. So this is not a value investment for me. This is hugely speculative, and it's not something I want to go into. What do you think? Write it down below. Have a good day.